In my 35 plus years of studying the financial markets, I've come to the conclusion that options trading by far is the best way to generate consistent, reliable income from trading. Although it may not be passive income, it's pretty darn close. And once you get the hang of it, it's actually fun. If you're new to options and you want to learn the basics so that you can become a successful options trader, you're in the right place. Hi, I'm Andrew, and I've been studying the financial markets for most of my adult life. Everything from fundamental analysis to technical analysis and everything in between. And I've come to the conclusion that unless you're in it for the long haul, most of that doesn't even matter. The way I've been able to generate reliable, consistent income from trading is through options. I honestly don't understand why more people aren't doing it, and I think it's just from a lack of awareness. So I decided to start a YouTube channel to share my knowledge for anybody who's interested. My goal is to bring you better options. In this video, I'm covering the basics of an option. Now, I know that in this instant gratification society that we live in, everybody wants results yesterday. But if you want to be successful in options trading and hang around for the long haul, you need to understand the basics and then work your way up. So let's start with a little background about options. Where did they come from? How did they get started? And how did they evolve? Options have actually been around a very long time. As a matter of fact, there is evidence of options contracts existing as far back as ancient Greece. The Greek philosopher Thales is said to have used an options contract to profit from an expected large olive harvest. However, formal options trading as we know it today has evolved over the centuries. So what is an option anyway? Well, let me give you a definition of what an option is. An options contract is simply an agreement that gives one party the right, but not the obligation, to do something within the future, usually within a set time frame. This something could be to buy or sell an asset, but it could also be to take some other action. Let me give you some examples of where options contracts are used. One example is real estate. A buyer might secure an option to purchase a property at a certain price within a certain time frame, allowing them time to secure financing or conduct due diligence. Another example is movie rights. A film studio might buy an option on a book, giving them the exclusive right to adapt it to a movie within a certain period. They can decide whether or not to exercise that right and produce the film. And the last example that I have here is an employment contract. Some jobs offer stock options as part of their compensation, giving employees the right to buy company stock at a certain price in the future. One of the simplest examples I can give you of an option is a grocery store coupon. Technically, that is an option. Let's say, for example, that you have a BOGO or a buy one, get one free coupon for some Pop-Tarts. I'm not sure why you would want to use that, but hey, that's your prerogative. I don't know, maybe you got some kids at home and they love them, but whatever. Technically, that is an option contract. That coupon gives you the right, but not the obligation, to buy 2 boxes of Pop-Tarts for the price of 1. And because that coupon has an expiration date, you must make that purchase within a set time frame. Now, the big difference with this type of option is that the company that's offering the coupon is offering it to the general public rather than a specific person or a specific entity, and there's typically no cost or obligation on the coupon holder or option holder's part other than to present the coupon when checking out. But technically, it does meet the definition of an option. All right, so now you hopefully have kind of an understanding of what an option is, but how does all this relate to the financial markets and options trading? Well, now we're getting into the meat of it. When used in the financial markets, options are referred to as derivatives, and this is because the price of an option is derived from the price movement of the underlying asset. Options contracts can be bought and sold on most financial instruments, such as stocks, bonds, ETFs, futures, and indexes. They're not always available on all instruments, but they're usually available on most of them. So the option contract really doesn't give you any tangible ownership in any asset. It only gives you the right to have or to sell that ownership. So we know that options contracts have been used as far back as ancient Greece, but what about the history of the use of options contracts in the financial markets? Well, believe it or not, this type of trading has been traced back by the historians to the 17th century in Amsterdam. The Amsterdam Stock Exchange saw active trading on options contracts and is considered one of the earliest documented instances on organized options trading on financial instruments. However, while options existed, they had several drawbacks. Number one, lack of transparency. Pricing and trading information wasn't readily available. 2. Liquidity challenges. Finding a counterparty for a specific options contract could be difficult. And 3. Counterparty risk. There was a higher risk of default by one of the parties involved in the trade. So how did these issues get fixed? That's when the Chicago Board Options Exchange, or CBOE, comes in. The CBOE was founded in 1973, and they pioneered standardized exchange-traded stock options. This revolutionized options trading, providing a centralized and regulated marketplace. Alright, so now that we've learned all about the history of options and how they've evolved over time, let's talk about how they work in today's financial markets. In today's financial markets, an option gives the owner the right to buy or sell a certain number of shares of the underlying asset at a specified price on or before a specific date. The specified price is also known as the strike price. The specific date is also known as the expiration date. The right to buy the underlying asset is also known as a call option, and the right to sell the underlying asset is also known as a put option. So let's take a look at an example with AMD. And if we were to take a look at the AMD stock chart, you would see that it's currently trading at about $115 per share. It's technically $115.90, but let's just say $115 per share for illustration purposes. Now, if we thought that AMD was going to rally up to $125 per share, what we could do is we could buy a call with a $120 strike price that expires on February 21st. Remember that if you were to buy this call, it gives you the right, but not the obligation, to buy AMD stock at $120 per share. If we were to take a look at the options chain, we would see that this would cost you $5 to buy the option. Or actually $500 since one option controls 100 shares. You have to multiply the price of the option by 100. So this actually allows you to control $11,500 worth of stock for only $500. Now, if the stock goes up to any price over the strike price of $120, you can realize an instant profit by exercising your option to buy the stock at $120 and then turn right around to sell it at the current stock price. Let's say $125 to give you an instant profit. In this example, you'd earn $5 profit per share or $500. In other words, for only a $500 investment, you were able to generate a $500 return or 100% in less than a month. Sounds fantastic, doesn't it? Well, it's not. Do not get sucked into this game. It's where many traders end up destroying their life savings and having to start over. So what happens if AMD doesn't hit $120 by expiration? Well, then the option expires worthless. You lose your $500 and the trade is over. So why would a trader want to buy the option instead of just buying the stock outright? Because it gives them leverage. To buy 100 shares of the stock outright, you need $11,500. And if you buy at $120, sell at $125, you make $500 or a 4.5% return. But to buy the call, you only need $500. And if you're able to use that option to buy the stock at $120 when the stock is actually worth $125, you will make the same $500 return. But in this scenario, the rate of return on your $500 capital investment is 100%. You doubled your money in the same amount of time. But again, don't get sucked into this game. You will lose in the long run, I promise. This simple diagram represents a call option. The beginning of the line is when the option position was opened. The end of the line represents the contract expiration date, hence the stopwatch. The line itself represents the strike price. If the stock price is below the strike price, the option is what we call out of the money, or OTM for short. Basically, this means the option would be worthless if the stock price was at this level at expiration. If the stock price is above the strike price, the option is what we call in the money, or ITM. The option would now have value at expiration since the strike price is below the stock price. Remember, you have the right to buy at the strike price. The further the strike price goes in the money, the more profitable the trade is, and the more money the option owner can make. There's no limit since the stock price can increase to infinity. However, the loss is limited to the price that was paid for the option. If the stock price is out of the money at expiration, the option expires worthless and the option buyer loses the amount paid for the option. So in summary, a long call option is a bullish strategy that has unlimited upside profit and limited downside risk. Now this simple diagram represents a put option. You already know what the beginning of the line, the end of the line, and the line itself represents, so I won't go over that. But the difference here is that when we consider the option to be out of the money and in the money, which is the direct opposite of a call. If the stock price is below the strike price, the option is in the money, or ITM. And if a put is in the money, it has value at expiration, since you can buy the stock at a lower price and sell it at a higher price. If the stock price is above the strike price, the option is out of the money, since nobody wants to sell a stock for less than its true market value. As with call options, the further the stock price goes in the money, the more profitable the trade is, and the more money the option owner can make. However, with puts, there is technically a limit to the profit since the stock cannot go below zero. Despite this, we typically say the profit is unlimited, even though we know that's not entirely true. But just like the calls, the loss is limited to the price that we paid for the option. If the stock price is out of the money at expiration, the option expires worthless and the option buyer loses the amount paid for the option. So in summary, a long put option is a bearish strategy since it profits if the stock drops below the strike price, which has unlimited upside profit and limited downside risk. Now investors can also sell options. Any investor, just like you and me. Now, buying options, or what we call being long options, is generally a bad idea. I'll get more into that in subsequent videos, but I make most of my profits from selling or being short options. So let's go back to our diagram to illustrate this concept. This diagram represents a short call option. As investors who are selling options, we generally want the option to expire out of the money. Options that are out of the money will never be exercised, and if an option is never exercised, it will expire worthless, and the option seller gets to keep all the premium collected. So remember, with a call, when the stock price is below the strike price, the option is out of the money, which is exactly what the option seller wants. And again, if the stock price is above the strike price, the option is in the money. This is typically what we don't want to see as an option seller. And because the stock can theoretically go in the money to an unlimited magnitude, the option seller can experience unlimited losses. Now, there are a number of defensive strategies to either minimize or even prevent those losses, which I'll go over in subsequent videos. But if the option seller never utilizes any of these defensive strategies, he or she could experience unlimited losses. So in summary, a short call option is a bearish strategy that has limited upside profit and unlimited downside risk. And finally, we'll cover the counterpart to the short call, which is the short put. Here's a short put option diagram. Again, when we're short options, we generally want options to expire out of the money. With a put, when the stock price is above the strike price, the option is out of the money, and again, that's what we want. But if the stock price is below the strike price, the option is in the money, not what we want. And the same holds true for a short put, where the stock can theoretically go in the money to an unlimited magnitude, meaning the put seller can experience unlimited losses. To summarize, a short put option is a bullish strategy that has limited upside profit and unlimited downside risk. One of the biggest mistakes I've seen people make when it comes to trading options is they try to make money buying options instead of selling them. And although you can make big money if you're right when you buy an option, your chances of being right are actually significantly lower, even lower than if you were to just buy the stock, which at best is 50-50. The reality is that buying options puts the odds against you. On the other hand, selling options actually can put the odds in your favor. It's literally like being the casino instead of being the gambler. A major factor that puts the odds against you when buying options is how they're priced, which is based on the Black-Scholes model, created by two brilliant mathematicians back in the early 1970s, which earned them a Nobel Prize. Options pricing is beyond the scope of this video, but one of the components of option pricing which really puts the odds against you is theta, which is the component of time. Part of what gives an option its value is that there is a certain amount of time for that bet to be correct. The more time there is, the greater the likelihood that the bet will end up being correct. However, those chances go down as time elapses, and so does the option's value that's attributed to theta. We call this theta decay or time decay. In other words, the theta value of an option is constantly declining until expiration, at which point it reaches zero. So in order for an option's overall value to increase, the value of the underlying asset must increase in order to overcome the decrease in the value of theta. It's actually possible for you to lose money if you buy a call in hopes that the stock price will go up, even if the stock price does go up, but just not enough in order to overcome that theta decay. Don't you think it makes more sense to put yourself on the other side of the trade? Wouldn't you rather profit from time passing? So would I. Options trading is very dynamic and flexible. Many strategies have been devised to be used in different scenarios, such as naked calls, puts, straddles, strangles, credit spreads, ratio spreads, calendars. But don't let this overwhelm you. There's no need to learn all of the strategies in the beginning. And it's actually beneficial to start trading some of these simpler strategies so that you can learn the dynamics of options and be able to better understand the more advanced strategies. In upcoming videos, I will show you what you need to focus on in order to get started so that you won't feel overwhelmed. There are some additional terms that you will need to understand in order to have long-term success with options trading, and those include premium, intrinsic and extrinsic value, theta or time decay, which I touched on today, volatility, delta, open interest and volume, liquidity, gamma, margin, and several others. Well, I hope this video helped you learn the basics of options trading. As you can probably tell, especially if you're a beginner, there's a lot to know and learn, which is why I'm dedicated to releasing more content on a regular basis. So if you're interested in learning more, be sure to hit the like, subscribe, and the bell notification. Also, each week I release a video covering the trades in my own personal portfolio. I cover them in detail, including the profit and loss I made for each, as well as my overall performance for the week as compared to previous weeks. Not only does this let you see that it's definitely possible to make consistent income from options trading, it's a good way to learn if you're looking to do some options trading for yourself. And finally, if you want to learn the basics of the Wheel of Fortune strategy, which is the strategy I use to generate consistent income each week, click on the video on your screen. Thanks again for stopping by, and I look forward to bringing you better options in the future. Bye-bye.